Hi, very good morning to all of you. There is a curse or a blessing in Russian which says that may all you live in interesting time. I don't know right now is it blessing or right now it is curse, but we are all living in interesting time and at least for next 6 months it's likely to continue. This is my favorite slide. I had used last time in Kotak conference also. This kind of gives confidence about India. It's a fantastic slide to talk to anyone who has doubt on India. This is the price chart of Maruti since its listing in 2003. And if you focus very hard, there are some red, blue, green line trying to come up from the bottom. That belongs to giant companies like Honda, Toyota, Nissan, and Suzuki. Since its listing in 2003, and despite 30% corrections in recent time, Maruti in US dollar terms have delivered better return than Honda, Nissan, Suzuki, and Toyota put together. And mind you, Suzuki owns 53% of Maruti. Despite Maruti's valuations and market cap getting reflected into Suzuki, Maruti still outperforms all of them together. This is India. पैसा बनाना है मारुति में इन्वेस्ट करो, नहीं बनाना है जाके होंडा, टोयोटा, सुजुकी, निसान जो लेना है ले लो. There is a saying which says that unless until you enter tiger's cave, you can't catch its cub. So in market also, you have to handle the tiger. This is the picture from Maruti's in-house factory camera. Recently in their Manesar factory, they had a leopard visiting. गाड़ी बनाना बाजू पे रखा, leopard को पकड़ा, जंगल में भेजा, फिर वापस गाड़ी बनाना चालू किया. This kind of adventure and thrill is only available in India. This kind of adventure and thrill is not there in Hondas and Toyotas and Nissans and Suzuki's factory. Market में भी कभी-कभी leopard आ जाता है. If you don't become its food, then you have a great opportunity to make money. Now, let's just recapture quickly what happened in last 1 year. In some sense, Indian economy caught into a perfect storm. This is that George Clooney movie where a fishing expedition went haywire and they landed up in a space where 3 storms were raging together. In our case, oil prices went up by about 55% from $55 to $80. The good news is that oil prices are correcting like crazy. As of today morning, they were trading at $63 a barrel. Typically, when your oil prices went up, current account deficit comes under pressure. Rupee was appreciating from 2013 to 2017. It moved from 68 to 63. It gave up all the gains in 2018, where it depreciated by 14%. The good news is that now rupee seems to be stabilizing. Of course, it won't appreciate significantly from here, but at least that big depreciation seems to be behind us. If your currency is depreciating, the only reaction a central bank can give is to raise interest rates. We did see our interest rates climbing by almost 100 basis points. The good news is that now interest rates have corrected by almost 50 basis points. Typically, probably this chart is not that visible, but this shows the banking liquidity in the system. Typically, when your currency is depreciating, you are selling dollars and taking away rupee. In the process, you ended up taking out banking liquidity. We were 1 lakh crore plus in September, October 2017. We became 1,50,000 crore short on 15-16 September 2018. So this shortage of liquidity also created its own stress on the corporate balance sheet. If all those things were not good enough, we had ILFS moving from AAA to D in a very short period of time. And it did caught a lot of bankers and investment managers by a surprise. On top of it, India was outperforming massively all other emerging markets. If we see over 2013 to 2018, India outperformed in US dollar terms China, Russia, Brazil, South Africa, Indonesia, Turkey. So that pushed FIIs to take profit out of India. We did see about $8 billion worth of selling by FIIs in equity market, about another $8 billion in debt market, total $16 billion gone. Finally, that resulted into carnage, which we witnessed towards October 2018 at peak. In dollar terms, index was down 20% on large cap, 37% on mid cap, and 52% on small cap from their 52-week high. The good news is that majority of bad news is already into prices. Why do I make that statement? One, rupee is now its near fair value. On a 10-year as well as 5-year average, rupee seems to be fairly priced. Second, interest rates are at pretty high level of 4% plus in real interest sense. There are very few countries in the world where nominal interest rates gives you 4% return. Here, real interest rates are 4% plus. And we have already seen debt FII turning positive. They have started nibbling in Indian market. If you look at US interest rates, they are rising undoubtedly, as Kamlesh mentioned. But fortunately, we are in a far better position to tackle rising US interest rates today than any other country in the world. The 10-year historical average between US interest rates and Indian interest rates is roughly about 4.7%. We are pretty much over there. So effectively, despite Indian yields coming down by 0.5%, we are still in a reasonably good shape to tackle rising US interest rates. In terms of liquidity, RBI finally has started providing liquidity into the system. We are still negative at about 60,000-70,000 crore to 90,000 crore, depending upon whose number you take. But at least it's turning positive. On ILFS, the situation has been contained. There will be some amount of haircut for the lenders, but it won't be a complete write-off. So even ILFS issue finally will be behind the market. More importantly, the industrial production numbers have started improving, and our inflation numbers, despite oil at $80-85 a barrel, has been reasonably subdued. If you look at earnings estimate, compared to all our peers in Asia-Pac region, the earning estimates for India seems to be reasonably ahead of their peer group. Hopefully, that should attract foreign investors into the country. Most importantly, from a valuation point of view, Kamlesh showed you in terms of pictorial how valuations have corrected. I'm trying to prove the same point through numbers. On 16 Jan, small cap index was at 34% premium to its 10-year historical price to book. On 31st October, it was at 5% discount. Large cap was at 10% premium. It was at 2% discount. Mid caps from 33% premium is roughly at about 11% premium. So effectively, what was available at a premium in Jan 2018 is now available at little below historical average in October 2018. Valuations are now in your favor. This is the other way to look at from FII point of view. When will they start bringing their money into India? So effectively what we have done is on a rolling basis of 6 months, the MSCI India return over MSCI Emerging Market Index return. And if you notice another 5%, 10% correction in market, which as of today looks unlikely because of drop in oil prices, but that would have made India attractive from a foreign flow point of view. So now markets are moving on the domestic flows, but if we had 5% correction, then the FII selling definitely would have stopped, and we could have started seeing some amount of buying from FII. So this is another way to again prove the same point, that valuation wise now things are becoming normal. Now, there is this whole topic about RBI and government. At least till day before yesterday, it was reaching across the media. There were rumors that governor will resign. I think if you have to see, is there a difference of opinion between RBI and government? Answer is yes. One is about liquidity. The government wants positive liquidity. RBI is keeping liquidity in tandem with their inflation outlook. The second is transmission of liquidity. Government wants money to go to SME, to NBFC, to real estate and infrastructure. RBI is saying that is job of the banks, not of central bank. And the third thing could be cost of liquidity. If you have to raise capital at 4% real interest rates, anyone can do it. You don't really require central bank for it. Shouldn't they be raising capital at 1% or 0.5% or negative real interest rates? So these are the three problem areas where there could be difference of opinion between government and RBI. Fortunately, post the board meeting on November 19th, clearly there seems to have been rapprochement. And this slide was prepared before the RBI board meeting where we were predicting that since the governor has gone and met the PM and FM, hopefully they will realize each other's viewpoint and they will hopefully meet halfway. So while media is trying to highlight the difference of opinion between RBI and government, I think both of them are working on the same page. They will meet halfway. Some tension is necessary between RBI and government because they are looking the same things from different point of view. But I think they are in the same team. They are not in the opposite team. Now let's look at market from a sectoral valuation point of view. This is the automobile sector. And the way to look at this chart is that there is a black line which shows the average of automobile sector over last 10 years. And the red line shows the valuation of automobile sector over the years. Currently, automobile sector, which includes two-wheeler, commercial vehicle, four-wheelers, trading at a premium to its historical average. But as you can see, the premium has corrected in recent time. Now, simple analysis of this chart shows that when today you are buying automobile sector, you are willing to pay a premium compared to its historical average, which means the growth rate of automobile sector should be higher than its historical average, or the expected profitability growth should be higher compared to its historical average. My guess is that a lot of this will depend upon how NBFCs continue to finance automobiles. In the Diwali season, clearly automobile sales happen by providing discount. A colleague of ours bought Honda City at 1,10,000 rupee discount. I don't know what's the price of Honda City, but it will be probably about 10 lakh or 11 lakh. So you got 10% discount to induce a buying of a car. So in this sector, you are paying a premium to its historical average, but please keep a watch on NBFC, which will provide financing through which automobile sectors will be able to produce volume, and with that volume, hopefully they will make profit. This is the cement sector, again trading at a significant premium to its historical average. This is primarily telling you that there is consolidation happening in cement sector, and despite competition commission levying charges of cartelization, market is expecting that there will be price stability on cement, and cement companies will continue to earn more than their historical average. With the kind of consolidation which has happened, this is pretty much on expected line. The kind of capacity addition which is happening, that is also pretty much on the expected line. So this premium valuation of cement sector will be justifiable provided you believe the consolidation of industry will result into better realization. This is consumer staple. This is all the FMCG sector. They have been trading at a significant premium to market as well as significant premium to its historical average. Of late, there has been some amount of correction. But again, the call here is that these companies will continue to make supernormal profit compared to their past historical average. In all these companies, there is a huge component of royalty. Royalty has already crossed about $7 billion payment on an annual basis. Many brands, and I'm just taking name for the sake of taking name, for example, Lux. Is the brand Lux created because of the advertising campaign in India, or is it created because of the brand overseas? Who knows? Now, if there is a royalty payment on Lux, should it continue at flat rate forever? Or should it decline as Indian heroine starts pushing Lux to Indian consumers and we don't have to depend upon foreign heroines to come and create that brand? At some point of time, as per this chart, royalty payment to the parent companies by the FMCG companies will decline. And that's where these premium valuations are justifiable. The day you see royalty payments declining, that will be a great opportunity. If we see consumer discretionary, there also, like consumer staple, valuations have remained at elevated level. Some amount of correction because of the recent time. But hopefully, again, on this sector, similarly to consumer discretionary and consumer staple, there is some element of reduction in royalty payments. This is Pharma P. Again, it has been trading at a premium despite not generating performance. The valuations have started correcting partly because profits have gone up and prices have corrected. It's one sector where a lot will depend upon what happens in the US market rather than what happens in Indian market. Very difficult sector to track. But in a volatile market, this will prove to be a defensive sector, especially with rupee touching 71, 72. Private banks, surprisingly, are now nearing their historical average. This is the period where the liability franchise is going to determine what kind of asset growth you can create. It's no longer the market where liquidity was plenty and you could have kept on lending money without worrying about where it will get financed from. The private bank's liability franchise or deposit taking ability is restricted compared to public sector banks. Public sector banks are available in every nook and corner of India, and despite their losses, the faith of depositors haven't been touched. And probably if you believe that liquidity will improve, liability franchise of private banks will improve, then this is a great time to buy private bank. If you believe that no, liability franchise will not improve, then probably this is still not the best time to buy private banks. I genuinely believe that liability franchise of private banks will continue to improve with technological usage. This is the technology sector available at their historical average valuation. This probably again reflects more of global market rather than local market. This probably also reflects inability of our tech companies to move into cutting edge, whether it's related to artificial intelligence, cloud computing, cybersecurity, or data analytics kind of work. We are still stuck in the old economy kind of technology. So at some point of time, if this historical valuations have to be broken, that barrier has to be crossed, we need companies which will go and invest into the future or which will show revenue from the future stream where explosive growth can come. This is the industrials. For years, private industrials, private capex has remained muted. No wonder that's reflected into the derating of this sector. It's almost available near its historical valuation. If you believe in 2019 we will get a stable government, entrepreneurs will go back to spending money on capital expenditure, then this is the time to look at industrials. If you believe in 2019 we are going to get coalition government and no entrepreneur is going to put his money in India, this is the time to go and short this sector. This is the PSU bank. They have been available below their historical average, but somewhere you could see some small recovery has started happening. That's essentially because market is believing this PSU banks have great ability to raise deposits from public, and that deposit raising will now be the constraint on financial services sector. This is utilities. The government policies in power sector, utility sector is a bit of a conundrum. On one side, we have now merchant power rates going into double digits, 10 rupee, 11 rupee, 12 rupee. On the other side, we have power stocks available at historically low valuation. One really doesn't understand how to analyze this sector. If you had analyzed on demand supply basis, by this time you would have lost your job. This is the metal sector, primarily reflecting global concerns. The kind of volatility we have seen, oil prices and steel and aluminum and zinc and all other products, that's pushing a cap on the valuation side. This is the energy, oil and gas, again related to global factors, significant amount of derating over there, and who knows, everything will depend upon where oil prices move. Effectively, I've tried to give you how sectoral valuation looks, but this is one more way to look at those sectoral valuation. This chart shows over last 15 years how sectoral market cap has moved. One thumb rule which has worked pretty well for me, that any sector, when it becomes excessive representation in the market cap, by and large that becomes the top of that sector. We saw that in telecom media technology in 2000. We saw that in infrastructure in 2008. Somewhere banking and financial services reflected that in 2017, 2018. Mid-caps also reflected that in 2017, 2018. So effectively, if a sector is getting overrepresented in market cap vis-a-vis its contribution to the profitability pool or vis-a-vis its contribution to the overall GDP, then probably it's worth underweighing that sector. So if you combine this analysis along with your sectoral valuation and then the bottom-up stock picking, hopefully you'll have 2-3 prisms through which you can figure out which stock to buy, what portfolio to build. The other thing which you have to look at is that in recent times, since especially May 2018, majority of flows which have come into India from FII is ETF related. And these are not Nifty ETF, Sensex ETF, these are MSCI ETF. So stocks which are part of MSCI index, they are getting disproportionate buying courtesy ETF flows. Similarly, in Indian capital market also, a fair amount of flows are now coming into Nifty ETF managed by SBI Mutual Fund and UTI Mutual Fund. This is the Employees Provident Fund organization giving them money. Some other provident fund also give them money. Roughly about 35,000 crore comes into this ETFs every year. The size of those ETFs are now in excess of 50,000 crore. So many of the large cap stocks in index will get buying purely because of EPFO flows. Now, when you're looking at buying stocks or portfolios, do consider that there will be some amount of buying of EPFO, about 35,000 crore a year in Nifty stocks, and substantial amount of FII flows are today coming from MSCI index. The other thing which Kamlesh mentioned and I want to collaborate is that Nifty Junior has underperformed Nifty Senior by significant margins since Jan 2018. Probably it's reaching a point where Nifty Junior looks more attractive. My guess is that if we don't get a surprise on election, over next 6 to 12 months, stocks in 51 to 100 market cap has a better chance of outperforming stocks in 1 to 50. What are the risks which we should be cognizant of? The one big risk which we should be cognizant of is MSCI. We have about $400 billion of FII investments in India at current market value, give and take 5% here or there. This is based on our weightages in MSCI index. Our current weight is about 8%. Most FIIs are overweight India. Let's assume, and this is pure assumption, not all FIIs are benchmarked to MSCI. There will be some India dedicated fund, there will be some ETF. So this is pure theoretical calculation. Let's assume that 12% is the overweight of FIIs on India. So effectively, against an index weight of 8%, we are at 12%. Now China's weight is about 28%. But most investors are underweight China. Let's assume that people are at 18% weight in China versus 28%. Over next 3 to 4 years, China's weight in MSCI index will go up to 50%. As MSCI emerging market index becomes MSCI China and other emerging market index, India's weight will come down from 8% correspondingly. Let's assume that it becomes 6%. Will people continue to have 12% weight in India when our index weight is 6%? Unlikely. Assuming that they maintain similar overweight on India, which is 50%, against 6% index weight, we'll probably have 9% weight in FII portfolios. If that has to happen over next couple of years, that means at current market value, FIIs have to divest almost $100 billion. That's the kind of selling possible if MSCI emerging market index weightages change as per the proposed plan. So this is one big thing, and we need our regulators, our government to go and engage with MSCI to ensure that our weightages does not get impacted. Is it possible? Answer is yes. 3 of the largest Indian banks, HDFC Bank, Kotak Bank, IndusInd Bank, are not part of MSCI indices. It's an irony or stupidity or our fallacy where a Chinese bank which allows 20% FII investment is part of MSCI index, and HDFC Bank, which is owned 74% by foreigners, where every day thousands of shares are traded between FIIs, and every single capital raise of HDFC Bank is contributed more than 70% by foreigners, yet HDFC Bank is not part of MSCI index. So if we get our weight intact, that $100 billion selling will not happen. If we don't do anything, then potentially over next couple of years, between 3 to 4 years, you will see FII selling at today's market value $100 billion. The second thing obviously is oil. Oil prices are down, India is up. Oil prices are up, India is down. Elections obviously will cast its shadow. Now, if you see on a longer term basis, elections don't matter. In 2004, post-elections, market corrected 20%, and we had mother of bull run between 2004 to 2008. In 2009, market went up 20%, and then from 2009 to 2014, market didn't move at all. So on a longer term basis, elections don't matter. But on the day of the election results, if you are on the right side, you'll probably make 15-20% return on your portfolio. And if you are on wrong side, you will probably lose 15-20% of portfolio. So over next 6 months, elections will continue to cast its shadow. The third thing which I'm worried about market, and I really don't understand this as much, is why is the volatility so low? Somewhere is market getting complacent. When oil prices were going up, we did see a carnage in mid caps and small caps, but there wasn't much impact in large cap. The interest rates market and the currency market was far more sensitive, far more volatile compared to equity market. The sanguinity of equity market kind of is unnerving. What is pricing risk so cheap? It's a bit difficult to understand. Who knows maybe election, maybe oil, maybe something else can pull the risk up and make volatility a little bit higher. The other thing, today market is supported by domestic mutual funds. Mutual fund flows as a percentage of NSE's market cap is now reaching almost 0.12, 0.13%. You see the historical average and the uptrend. All of you need to give money to me so that I can go and take care of the market. If you stop doing your SIP, if your uncle and auntie stop doing SIP, then don't blame if market comes down. So this is the message, Kamlesh bhai, sabko bol dena, check kaat le. You also have to pray for FII flows. They have been consistently selling throughout 2018, bearing few months in between. And as of today, we have almost reached a level where their flows as a percentage of market cap is turning into negative territory. Is it happening because globally central banks have started taking out liquidity? Is it like 2013 taper tantrum when the fear that US Fed will stop purchasing bonds and providing liquidity resulted into a crash in equity market? What was a fear in 2013 is a reality in 2018. And are we pricing this risk low? Are we not pricing this risk correctly? Who knows where the answer is? But there's no doubt that central banks' balance sheets have started reducing. US Fed has reduced. ECB will be stopping. Bank of Japan might reduce. Combination of that might result into FII not putting money into market. And if MSCI rejig happens the way China is planning, we might actually see reasonable amount of outflows. And that puts a cap on the equity market despite mutual funds being there. If I have to talk about long story, I just want to focus on one thing. There is a great opportunity for India to catch up with China. In 1980, India and China were of similar size in per capita GDP. They ended up becoming manufacturer to the world by building infrastructures, by attracting foreign direct capital, by inviting all the global companies to set up their base over there. And then China started outperforming India. Today, China is 7 times bigger than us. Fortunately, President Trump has gone and put tariff war on China. Goods exported out of China in America is getting taxed at 10%, 25%. Most of the buyers of this goods, like Walmart, like Amazon, have started advising their suppliers to move their base out of China. Recent economist articles suggested that food processing is going to Vietnam, footwear is going to Cambodia, textiles are going to Bangladesh, computers are going to Taiwan, electronics are going to Malaysia and Thailand. Unfortunately, India's name didn't appear. Do we make footwear? Well, we make for 1.3 billion people. And even if you want to assume that 100 million people don't wear footwears, it's still 1.2 billion, more than any other part of the world. Do we don't make clothing? I mean, will we clothe 1.3 billion people? If you want to take out 100 million people who don't wear clothes, it's still 1.2 billion people. So we are doing all those things. And yet, these industries are not coming over here. Amazon and Flipkart both have Walmart both have great interest in India. Walmart has put $16 billion in Flipkart. All we need is to approach them and say that, look, we have allowed you free entry in India. Can you ask your suppliers, instead of sourcing from China and then moving on to Vietnam, Thailand, Cambodia, why don't you come to India? We'll provide you whatever you need, footwear, food processing, textiles, computers, electronics, whatever it is. Is it possible? In India's case, it gives reason for optimists to be bullish, and it also gives reasons for pessimists to be bearish. In inorganic chemicals, we have captured this market which is moving away from China. The inorganic chemicals are growing at 35-40% year on year for last 3 quarters. So what we have done on inorganic chemical industries, if we can copy it in textiles, footwear, food processing, computers, electronics, whatever it is, we can actually create manufacturing base in India, and this will allow us to close gap with China over next 24 years. This is a lifetime opportunity which we missed in 1984, 1980. If we can capture it now, what today you are looking at in Sensex terms, I'm sure tomorrow you will be looking nifty over there. Is there reasons to be bullish about India? Answer is yes. If we see, our real issue was very, very poor tax compliance. Now, courtesy GST and demonetization and everything else, the tax base has expanded. Before 2016, there were 64 lakh units which were declaring taxes. Now they are up 75% courtesy GST and demonetization to about 1.1 crore. Obviously, we haven't created those many new units in last 2 years. These are all black market parallel economy businesses coming into real economy. Number of people filing income tax return has moved from 4.2 crores to 6.8 crores, up 61%. In terms of job creation, if we look at EPFO data, we were struggling at 3 lakh, 4 lakh jobs in organized sector every month. Now suddenly that has started moving towards 7, 8 lakh. So somewhere economy seems to be picking up and it has started creating jobs. On the NPAs, there is settlement happening. Earlier, there was evergreening of NPAs. Now promoters are thrown out and their companies are handed over to someone else. This is efficient capital allocation. This probably explains why Western world have more efficiency, more productivity compared to, let's say, our country. Oil has been bugbear of India. Now we at least have a plan to reduce our energy dependency. We have plenty of solar power. In FY14, the total installed solar power capacity was 2.6 gigawatt. In 2018, 4 years, we have expanded this capacity to almost 23 gigawatt. As we keep on expanding solar capacity, our energy dependency on oil can start reducing, and combination of that over a period of time can result into softer oil prices. We are the third largest importer of oil in the world, and if our import of oil starts getting stagnated, obviously there will be impact on prices. I was in Abu Dhabi recently. They make about 2.5 million barrels of oil a day, and they have taken a call to expand the capacity to 5 million barrels a day. Essentially, they are saying that oil produced today will be more valuable than oil left behind in the ground tomorrow. So hopefully, the future of oil prices will remain soft, especially if we can prove to the world that, look, 10 years down the line, I'll have so much of solar capacity that I don't really care about your oil. That messaging will be critical to lower the oil prices today. Finally, I don't think so in my 25-year career I have ever read this kind of headline. An American company, Visa, is complaining, or MasterCard is complaining to their government, in India, rupee is being pushed by the government. When American president comes here to sell Boeing, they can't complain, we can't complain. But when our prime minister pushes rupee, and in this house, how many of you have rupee card? I am the only Indian in this. Oh, there are 3 Indians in this room. Great. So when did you last hear this kind of headline? When did we see our government focused on our interest rather than believing in Atithi Devo Bhava? And this is despite all of us. There are only 3 Indians left in this room. It will be If you have to summarize what's happening in India, it's transition of rule-based, relationship-based economy to rule-based economy. And if you have seen growth in many other markets, that has all happened when rule of law has prevailed. So hopefully the longer term future of India, despite near-term uncertainty on election, seems to be bright. Tax compliances increase, job opportunities increasing, energy dependency is coming down. Our bugbear oil should remain soft in the days to come, though in the near term it might bounce back because it is corrected too sharply. So hopefully all these things will start falling together and we will see a better opportunity. If we capture something like supply chain disruptions which is occurring in the world, over next 5, 10, 15, 20 years, we could see a growth which we have never ever witnessed, which we have always heard about in Taiwan, Korea, Indonesia, Philippines, Thailand, Malaysia, or such other countries. What's the risk? Well, the risk remains risk of self-goal. We are all quite capable of snatching defeat from the jaws of victory. I'm sure most of you know this gentleman, Falisam Nariman, a noted constitutional lawyer, a man, when he speaks, even Supreme Court listens. Padma Vibhushan, recipient of the second highest civilian award in the country. Most of you won't remember or would have even heard of this gentleman called Ghulam Dastgir. Anyone who has heard about him? Unlikely. So he was the gentleman who was posted as assistant station master in Bhopal in that December 1984 fateful night. On that day, there was a leak in Union Carbide factory, and Union Carbide factory was situated near to the track. There was no siren, which was normally the custom when there is a poisonous gas leak. The factory is supposed to, give message warning by way of constant sirening. That didn't happen. There was no television 24/7 which showed breaking news, Union Carbide mein gas leak hai. There was no mobile phone. He just sensed breathing air that something has gone wrong. And he asked his people to release the train ahead of its schedule, which was standing at Bhopal railway station. His subordinates kind of retaliated, saying that if we release a train before its departure time, our jobs will be at risk. Despite that, he said, I will take the blame on myself, but please release this train. So in the history of Indian Railway, for the first time, a train departed ahead of its scheduled departure time. He also stopped all trains coming from Delhi side into Bhopal, because if they had come into Bhopal station and moved ahead, they would have gone through the poisonous cloud. He also stopped trains coming from Mumbai into Bhopal station because they would have first passed through poisonous cloud and then come into Bhopal station. That single act of stopping train and not entering into Bhopal saved thousands of lives. As the night progressed, more and more people were getting ill. They were all coming into Bhopal railway station, and he was arranging transport of them into various hospitals. His own family was staying near Union Carbide factory. He didn't bother about them. Some of them actually died. He continued inhaling that poisonous gas, and that impacted his health forever. For doing all this great work, we, the ungrateful nation, don't even remember him. He doesn't get any Padma Shri, Padma Bhushan, Padma Vibhushan, Bharat Ratna. We don't even remember him. That's who we are. Nation of completely ungrateful people. And Mr. Falisam Nariman actually represented Union Carbide. And he gets Padma Vibhushan. Does any one of you feel that Ghulam Dastgir made a wrong choice? And he should not have done what he should have done? मतलब किसी को ऐसा नहीं लगता ना, क्या गधा था, फैमिली बचाना चाहिए, क्या पब्लिक की सेवा कर रहा था? Not even one of us. But when it comes to giving Padma Vibhushan, we choose the person who represented Union Carbide, not the person who fought against Union Carbide, not the person who saved thousands of innocent lives. That's how we, the nation, are. What should you do? Well, don't make self-goal. This was slide prepared before Diwali. My request was that during Lakshmi Puja, please pray to God, oil prices niche aa jaye. This seems to have happened. And please go and vote in May 2019. Don't take a holiday. If you vote for a sensible government, there is a great opportunity for India to capture, especially that supply chain disruption. This can help us close gap with rest of the world. Countries like China, Indonesia, Thailand, Taiwan, Korea, Philippines, we can close the gap with them. These are all the standard risk factors. Please read them very, very carefully. So, thank you.